TSS and BTE have joined forces.
Context,
Power.
edge.
The new paradigm of trading.
Picture this. It's early July 2026. You log into your brokerage account and everything is just green.
Yeah, wall-to-wall green.
Right. And the headline news on your feed is just blaring that the stock market has closed out its absolute best quarter in 6 years.
Which is massive.
It's massive. I mean, the NASDAQ is soaring. The S&P 500 is knocking right on the door of 7,500. And all around Wall Street, people are metaphorically and, probably literally popping champagne.
Oh, absolutely.
We're heading into the long 4th of July holiday weekend, and it just feels like this unstoppable, beautiful summer rally.
It's a great narrative. I mean, looking at this screen, you really can't blame anyone for buying into it.
No, of course not.
But, when we start peeling back the layers of how this market is actually operating right now, the actual mechanics of it, the reality gets incredibly complex and honestly a little concerning.
Yeah, concerning is putting it mildly. So for this deep dive, we've been going through a stack of internal trading notes from a quantitative firm called SpotGamma.
Right, and they map out the mathematical blueprints of the options market.
And the story their data tells is just drastically different from those happy headlines we just talked about.
Completely different.
So that is exactly our mission today. We are looking past the holiday fireworks and the surface-level green numbers to uncover what really looks like a massive, hidden, artificial market trap.
Yeah, we're going to decode why the smart money, the institutions that are moving billions of dollars around, why they are secretly preparing for a severe summer correction.
Right, at the exact moment the rest of the market is just celebrating.
Exactly, because in modern financial markets, the price you see flashing on your screen is, well, it's rarely a reflection of actual investors buying into the economy anymore.
Right.
It is almost entirely driven by the underlying plumbing of the options market.
Which is why, whether you're managing your own portfolio or, even if you just want to understand how modern finance actually operates behind the curtain, we're going to give you X-ray vision today.
We really are. We have to look at the mechanical gears and levers moving stock prices.
Yeah, and to really understand this trap, I think we have to start with why the market looks so deceptively strong right now. So let's unpack the holiday vol crush.
Oh, the holiday vol crush.
Yeah.
It's a fascinating mechanical quirk of the market, and it has absolutely nothing to do with companies suddenly becoming more valuable.
Or the economy booming or whatever.
Right, no. It comes down to pure math and time. So think about a long 3-day holiday weekend.
Okay.
The stock market is closed. But options contracts, which are essentially insurance policies on stocks, they're constantly losing value as time ticks by.
Because of time decay.
Exactly, that's time decay.
Because, if you buy insurance that expires on a Friday and 3 days go by where nothing can possibly happen because the market is totally closed,
Right.
that insurance is obviously worth less when Tuesday rolls around.
Yeah, precisely. Options traders know this. They know they're going to bleed money over a 3-day weekend just from the sheer passage of time.
So what do they do?
Well, to avoid that, leading into the holiday, they aggressively sell their options.
They sell volatility.
Yes, they sell volatility. They just dump these contracts to get them off their books.
Okay, let me stop you there, because here is where the mechanics get really, really interesting. When all those traders are selling their options, they aren't just, vanishing into thin air.
No, someone has to take the other side.
Right. There is a market maker, a massive financial institution on the other side of that trade who is forced to buy those contracts.
And those market makers operate under very strict mathematical rules.
Yeah.
They are not in the business of taking directional bets on the stock market.
Like betting it'll go up or down.
Right. If a market maker buys a bunch of options from traders, their internal risk algorithms instantly force them to hedge that position.
They have to balance the scale.
Exactly. In the industry, they call this staying delta neutral.
Okay, so if I understand the plumbing correctly here, to balance that scale, to stay delta neutral when everyone is just dumping options, the market makers are forced to go out and buy the underlying stocks.
Yep, or they buy index futures.
Wow.
That is the exact mechanism. Millions of options are being sold, which mechanically forces the market makers to buy billions of dollars worth of stock to hedge their books.
Which creates this massive forced buying pressure.
It does. It pushes the S&P 500 and the NASDAQ higher and higher, but the key here is there is no actual fundamental conviction behind it.
Right, no one is buying because they love the company.
No. They're buying because a computer algorithm is forcing them to balance a ledger. It creates this total optical illusion of market strength.
And we saw this illusion executed flawlessly on June 30th. I mean, the S&P 500 rallied right up to 7,499.
Literally one single point shy of the 7,500 milestone.
Yeah, just 1 point away. And the notes from SpotGamma point out something they call quarter-end pinning at that exact 7,500 strike price. What does that mean exactly?
So the data reveals that options dealers were holding a massive concentrated position at that specific 7,500 level.
How massive?
We're talking about approximately 38,000 call contracts clustered right there.
Wow!
Yeah. And as the index rallied toward 7,500, the mechanics of delta neutrality kicked in again. As the price got closer, dealers actually had to start selling stock to keep their books balanced.
So those hedging flows act like a physical barrier.
They do. They reinforce that 7,500 level, turning it into a massive, impenetrable wall. The market essentially gets pinned there.
Okay, so there's a concrete ceiling above. But underneath the market, the notes say these dealers are holding what's called massive positive gamma.
Right, positive gamma. It's a term that gets thrown around a lot, but its practical effect is really what matters to us here.
Which is what?
Well, when dealers are in a state of positive gamma, their hedging requirements flip the normal dynamic of the market. If the stock market drops 10 or 20 points, their risk models force them to buy stock to stay neutral.
Wait, really?
Yeah. And if the market rallies 10 or 20 points, they are forced to sell.
Wait, so if they are constantly forced to buy every single time the market dips, I mean, looking at the sources, is it almost like a knight's shield underneath the market?
A knight's shield?
Yeah, like any downward blow, any intraday dip gets instantly deflected by these algorithms stepping in to buy.
Actually, yeah, a shield is a highly accurate way to visualize it. It artificially dampens volatility.
Because the market doesn't crash.
It doesn't even really pull back because
Yeah.
the algorithms are constantly catching it. To the average retail investor watching on TV, the market looks totally invincible. Every dip just gets bought.
But again, it's not genuine strength. It's just an algorithmic shield. And if we put this all together, the market isn't just flying high, it's actually trapped.
It's completely wedged.
Yeah. It's wedged tightly between this positive gamma shield, catching every dip from underneath, and that concrete wall of 38,000 call options, capping it at 7,500 from above.
It is basically floating in an artificial zero-gravity vacuum created by the holiday.
Which brings us to, honestly, the most tense part of this entire deep dive.
Yeah, the warning lights.
Right. Because if the market is perfectly shielded and just floating peacefully upward into a long weekend, why in the world are the internal SpotGamma sources sounding a massive alarm?
Because while the surface of the ocean looks perfectly glass calm, the mathematical warning lights down in the engine room are flashing bright red.
What are they looking at?
They're tracking a proprietary indicator called Core 1M.
Core 1M. And the notes reveal this indicator just dropped down to a level of 5. Now, quantitative research notes are usually incredibly dry, right? Like super academic.
Very dry.
But when they saw this reading of 5, the analysts literally called it the bat signal for spasms ahead.
Yeah, spasms ahead is certainly not standard Wall Street jargon.
No. So what is Core 1M measuring?
Core 1M is measuring the 1-month implied correlation of the market. A reading of 5 means that correlation has almost completely broken down.
Meaning what exactly?
Meaning the individual stocks inside the S&P 500 are no longer moving together as a cohesive unit. They are moving wildly, violently, independently of one another.
Okay, let me push back on that for a second, though.
Sure.
If correlation is low and stocks are just kind of doing their own thing, isn't that just a healthy market? You know, the classic stock pickers market people talk about.
Yeah.
Good companies with good earnings go up, bad companies go down.
Right.
So why does low correlation suddenly become a bat signal for a massive market crash?
That is the natural assumption. Right. And isolated on its own, low correlation isn't necessarily dangerous. The danger lies entirely in the context of this specific low correlation.
Okay, what's the context?
The notes highlight that while correlation has completely broken down to a 5, the SPY, which tracks the S&P 500, is showing a call skew ranking of 85.
Okay, call skew. What does a ranking of 85 tell us?
Call skew measures how eager investors are to buy upside bets versus downside protection. A ranking of 85 indicates extreme, almost off-the-charts, retail euphoria.
Just extreme greed.
Exactly.
Yeah.
Everyone is piling into the boat to buy call options, fully convinced the market would just keep going up forever. No one is buying puts. No one is hedging.
Wow. So you have retail investors acting incredibly euphoric on the surface, while underneath, the stocks themselves are moving wildly out of sync.
And that combination creates what institutions call a highly unstable dispersion trade.
The dispersion trade.
Yeah. In a dispersion trade, sophisticated players are essentially betting that the index as a whole will stay calm, while individual stocks inside the index will experience massive volatility.
That sounds risky.
It's mathematically akin to stretching a giant rubber band in 50 different directions at the exact same time.
Oh, wow.
The tension builds and builds silently. And when that rubber band eventually snaps, when that extreme retail euphoria collides with broken institutional correlation, it historically results in violent, volatile spasms.
And the sources bring receipts for this, too. They point to recent historical examples on their charts where this exact setup materialized: extreme call skew plus ultra-low correlation. And in those recent examples, the QQQ, the ETF tracking the NASDAQ 100, it suffered sudden, seemingly out-of-nowhere drops of 5% and 7% right after this bat signal flashed.
The mathematical tension simply has to resolve itself. I mean, the market plumbing doesn't care about the holiday sentiment or the 6-year highs. When positioning gets this stretched, the unwind is aggressive.
Okay, so we know the warning signal is flashing in the data, but, a model is just a model. Are there physical cracks forming in the actual market yet? Can we see this tension snapping?
We absolutely can, but you won't see it if you only look at the major index headlines.
Oh, you have to dig deeper.
You have to look beneath the surface at the sector rotations and what we call the dark flows of options money. Let's look at July 1st, the day immediately following that glorious quarter-end close.
Okay.
The broader tech rally, which has driven this entire market, abruptly stalled out.
Yeah, semiconductors have been the absolute darlings of the 2026 market. And on July 1st, they plunged 5.4% in a single day.
Which is a huge move.
It's massive. That one move dragged the entire NASDAQ down 1.5%.
But that capital didn't just evaporate, though. It violently rotated. We saw massive amounts of money flee the semiconductor space and pour aggressively into software and space stocks.
Yeah, looking at the numbers from the notes, the software ETF, IGV, popped 3%.
Yep.
You had massive heavy-hitting names like Microsoft up 3%, Palantir up 8%, CrowdStrike up 6%.
Yep.
And the space sector ETF, SPCX, surged 7%. There was one particular stock, ASTS, that went completely parabolic, up 21% in a single session.
And that's exactly it. When you see multi-billion-dollar tech companies swinging 5, 8, or 21% in a single day while the broader market barely moves, that is the low correlation we were just talking about.
Right.
That kind of violent, erratic sector rotation is a tremor. It shows fundamental instability beneath the surface. But honestly, the most shocking data point from July 1st wasn't the sector rotation at all. It was an options flow indicator called HIRO.
HIRO. What exactly is HIRO tracking?
So, HIRO is a specialized data feed that tracks the real-time hedging impact of customer options trades. It essentially measures whether the total options activity on a given day is forcing market makers to buy stock or forcing them to short stock to hedge.
Okay, got it.
On July 1st, the S&P 500 IRO recorded a staggering negative $14 billion of net delta.
Wait, negative 14 billion with a B in a single session.
In a single session.
Wow. Just to translate that for you listening, a negative net delta means the options flow was forcing market makers to rapidly short the market to protect themselves.
Exactly. It was one of the largest negative readings SpotGamma had recorded in 30 days. And the data shows this massive negative flow was driven almost entirely by something called zero DTE options.
0 days to expiration.
Right. These are options contracts that are bought and expire on the exact same day.
So institutions were coming in and aggressively buying same-day put options. They were buying intraday downside protection.
Massive amounts of it. And they were simultaneously selling call options.
Think about the inherent contradiction here. It is mind-blowing.
It really is.
The broader market just locked in its best quarter in 6 years. Everyone on financial television is cheering. Retail investors are buying call options thinking we're going to the moon.
Right.
But behind the scenes, using these zero-day options, institutions quietly dumped $14 billion into negative delta hedging in a single afternoon.
They are acting on the bat signal.
Yeah.
These institutions see the CR1M sitting at 5. They see the extreme call skew and the fragility of that rubber band, the dispersion trade.
Right.
So they're using the cover of the low-volume holiday week when the index is pinned and barely moving to aggressively and cheaply load up on downside protection. They're basically buying the insurance before the storm hits.
So while retail investors are literally blinded by the holiday fireworks, the smart money is quietly packing their bags and heading for the exits.
Precisely. And, we are starting to see the actual fundamental fragility of the economy bleed through the gamma shield in specific sectors, too. Look at consumer discretionary.
Oh, you mean the Nike earnings? Yeah, that was a bloodbath.
It was. Nike suffered a brutal 9% drop immediately after reporting earnings. Now, the options pricing going into that earnings call had only implied a 7.6% move. So the sell-off was so aggressive, it completely blew past the expected risk parameters set by the market makers.
And that single drop dragged Nike down 36% year to date.
Down 36% in a year where the broader market is supposedly hitting multi-year highs.
Which proves the point exactly. Underneath this positive gamma shield, where everything looks fine on the index level, there are severe fundamental economic weaknesses in major legacy companies.
Exactly.
Okay, so we have fully decoded the illusion. We see the gamma shield catching the dips. We see the bat signal flashing with a correlation breaking down. And we have tracked the institutional money moving $14 billion to the exits using zero-day options.
The trap is set.
Right, the trap is set. So the obvious next question is, how do the sources say you should actually navigate this? What is the playbook when you know this trap is set?
Well, the very first rule, and this is a cardinal rule they emphasize heavily for this specific setup, is do not aggressively short the market right now.
Wait, what? That feels entirely counterintuitive. If we just spent the last 10 minutes proving that a massive correction is coming, shouldn't the play be to short the market immediately?
You have to remember the mechanics of that night shield we discussed earlier.
Oh, the positive gamma.
Yes. The positive gamma environment is still highly active. The market makers are still mathematically forced to buy every dip. The notes actually use a fantastic phrase to describe the danger here. They warn that eager short sellers will be fried before the weekend even starts.
Fried, meaning you will just get chopped to pieces by the algorithms.
Yep.
You try to short a 10-point drop, and the gamma shield instantly buys it back up 15 points, and you lose your shirt.
Exactly. You do not step in front of a mechanical algorithmic bulldozer, even if you know for a fact it's going to run out of gas eventually. The timing is everything.
So what do?
Instead of shorting blindly, the sources advise managing your risk using a specific trigger they call the risk pivot.
Okay, the risk pivot. The notes highlight the absolute center of gravity for the market right now is the S&P 500 at 7,380.
7,380 is the line in the sand. The playbook dictates that as long as the market stays above 7,380, you hold your short-term bullishness.
Just ride it.
Do not fight it. The gamma shield is working, the dealers are buying the dips, and the market can continue to float upward. But if a daily candle closes below 7,380, the entire dynamic flips.
The shield breaks.
The shield doesn't just break, it reverses. That is the point where positive gamma flips to negative gamma.
And what happens then?
When the market goes into negative gamma, the dealers' risk models force them to sell into a declining market.
Oh, wow.
Instead of buying the dips, they start selling the dips, which aggressively accelerates the crash. If 7,380 breaks, the notes indicate the trapdoor opens, and the market will likely plunge straight down to the next major area of support, which is a massive put wall sitting at 7,300.
Okay, so 7,380 is the tripwire we're watching. But in terms of actually deploying capital right now, what is the institutional investment strategy? What are they doing with their money while they wait for that tripwire to snap?
They are taking full advantage of the crushed implied volatility. Because of the holiday weekend and because the market is pinned at that 7,500 level, the VIX, the volatility index is sitting incredibly low.
Right, it's down in the 16s.
Yeah, and when the VIX is that low, options contracts are historically cheap.
It's just really cheap to buy insurance right now.
Precisely. So the sources advise buying cheap, out-of-the-money August, put spreads on the SPY and the QQQ. Use this artificial, mathematically induced quiet period to buy time-delayed downside protection for pennies on the dollar.
On the flip side of that, though, they give a very specific warning about where not to buy protection. They explicitly warn against buying volatility in the high-flying tech names, right?
Yes, they single out companies like AMD. In those high-momentum tech stocks, the implied volatility remains uniquely rich.
Meaning what?
Meaning, the options are still extremely expensive because everyone still expects them to keep making wild moves.
So if you buy a put option on AMD expecting it to crash and the whole market does correct, what happens?
You might actually lose money, even if the stock price drops.
Wait, really? How?
Because When the market corrects, the extreme volatility premium in those tech names might crush down to normal levels. You lose so much value on the volatility crush that it wipes out the profit from the stock dropping. You simply overpaid for the insurance.
Got it. So, distilling this playbook down, buying a put on the S&P 500 right now is kind of like buying hurricane insurance in the middle of a perfectly sunny, cloudless day, simply because the insurance company has drastically slashed their prices for a holiday weekend promotion.
That's a great way to look at it.
You can see the barometer dropping in your living room. That's our QR1 bot signal at 5, so you are building a defensive bunker on a massive discount.
That is a perfect encapsulation of the strategy. It is purely about proactive de-risking. The holiday silence we are seeing on the screens does not mean peace. It just means a temporary paralysis of the auctions algorithms. Once the holiday is over and the time decay resets, the volume will return. And when it does, the true structural weakness of that dispersion trade will be exposed.
Wow. Well, bringing this all together for you listening, the headline news on your feed is celebrating a 6-year high. But the true mechanics of the market, the dealer gamma shield, the $14 billion in zero-day options flows, and that glaring bat signal, they show us that the institutions are actively, quietly preparing for a severe summer correction.
Yeah, looking at all this data, it really forces you to step back and examine the landscape of modern finance as a whole. And it leaves us with a rather profound question to ponder as we watch the market this week.
Let's hear it.
If modern market movements are now this heavily dictated by algorithmic options hedging, by holiday time decay, and by dealer gamma positioning, is the era of traditional fundamental investing becoming obsolete?
That's a huge question.
Think about it. We used to buy a stock simply because the company made a great product or had strong earnings. But if the tail of the options market is now aggressively wagging the dog of the stock market, are we no longer trading companies? Are we just trading the underlying math of the options market?
A market where the fireworks aren't celebrating a booming economy, they're just distracting you from the math. It is definitely something to think about the next time you see a perfectly sunny day on Wall Street.